Almost a week late here, but I want to go over Shopify. This is a company that I was contemplating purchasing a couple of weeks ago, and they had earnings last Wednesday on the 27th. By the time this video gets out, today's 8/1. It'll probably be 8/2, which will be about 6 days out from earnings. But I want to go over what their earnings were, talk about some of the key parts that came out of it, what price I am buying Shopify at if we can get to those levels, and really, first of all, why would I be buying it in the first place? So hit the like button, subscribe, check out our Discord community down below. It's completely free. You guys get access to free courses, free live streams, free seminars, free webinars, and all of my free long-term investments. Go ahead and check it out. The link is in the description, and we would love to have you guys as part of the team. So let's go through and just look at earnings very quickly. Shopify on Wednesday ended up missing earnings revenue and for their second quarter in a row. Company also warned that inflation and rising interest rates would weigh on the consumer spending for the remainder of 2022, and the earnings results come one day after Shopify said it's going to cut 10% of its workforce as e-commerce activities recalibrate from the Roni surge. So obviously they probably had to hire a lot of people while everyone was stuck at home. And now they're laying some people off, which we're seeing a lot of companies do right now. So coming in on the numbers, coming right out, earnings, a loss of 3 cents per share adjusted versus the gain of 2 cents per share, which a lot of people were expecting. Revenue 1.3 billion versus the 1.33 billion that was expected, so just missed there. And the stock closed last Wednesday up 11%. Canadian company, so Shopify announced on Tuesday its subsequent stock fall appears to have de-risked its shares on Wednesday, said Tom Forte, an analyst at D.A. Davidson, who's holding a hold on the stock currently right now. That's their rating. Investors are closely watching earnings results from retailers and e-commerce companies to see how elevated inflation is and the threat of a recession for many impacting customer spending habits. The latest warning came earlier this week when Walmart slashed its profit forecast, which that was really not good. Amazon is set to report second quarter earnings, which they did really well. But still, across the board, guys, like with the potential recession looming, we're going to see consumer spending drop. And when 70% of GDP is consumer spending, that's not going to really help. Looking at Shopify, this stock is down drastically. I mean, drastically. We were trading up around 166, which they just did a 10-to-1 split, so $1,600 at one point, and now we're trading down. Today we closed at 35. So right now, looking at that would have been 350 a share, which it's down. I'm gonna have to go to TOS real quick, but looking at Shop, it's got to be down like 80 or 90% from highs. You're looking massive drop. So overall, it's starting to look attractive. Like from a trading perspective on the weekly, we have a nice descending wedge with a bullish divergence, squeezing, looking like we could get a run up to 72, but we're not looking at it from a trading perspective. We're looking at this as an investment. So market cap is 45.97 billion. Revenue for the trailing 12 months, as you guys can see, is going to be 4.3 billion. Net income is going to be $181 million. And also, you're going to notice the 5-year PE is a whopping 148. And the past trailing 12 months PE is 252. So, like, automatically not a fan. Like, just you're not getting a deal on this, to be quite honest. Profit margins at 3.8% and a 5-year profit of 12.9%. And then looking at the PS, the price of sales is 9.5. Even after all of this, 9.5. That price to earnings and 5-year PE is just disgusting. Income statement, however, hopefully is going to show a reason why the price to earnings is just stupid. Looking at this right here, let's just look firstly at revenue. You guys are going to see this is why. 2018 was 760 million. In 2020, it was 1.7 billion. So more than doubled their revenue in 2 years. 2020 to 2022, even with everything that's, the pullback that we're seeing here, 2020 to 2022 is 4.83 billion. So nearly tripling their revenue and nearly 10xing, like 8xing their revenue in 5 years, tripling their revenue in 2 years. So that's why we have an insane price and an insane valuation. I mean, it would be even crazier if we're still up at the 160s, but that's why. I'm not saying that that's, worth it, but like that's insane. And gross profits, you can see here, gross profits going from 431 million to 2.56 billion currently right now. And if we actually go through and we just scroll down very briefly, you guys are going to note that net income, which is very important. We need to make sure that the company's making money and that they're going to be holding on to their money. The net income went from a loss of 42 mil 5 years ago to this year making $181 million. Very, very good. So, is the company doing well? Just looking at that income statement, yes, they're growing. And not only are they growing at like a nuts rate, they're also keeping a lot of money. They went from losing money 5 years ago to keeping a lot of money this year. Now, current assets versus total liabilities is very important. Total assets are $11.3 billion as of right now, and total liabilities are going to come in at $2 billion. So that's really, really good as well. They have a lot of cash in their bank account. They could pay off their liabilities tomorrow 5 times, which is really good. Going through, just looking again, 5-year PE is just disgusting. 148. It's just stupid. Shares outstanding is 39.6%. They are diluting shareholders pretty heavily. I'm telling you right now, before we go into the stock analyzer, I like the company. This is why I was looking at them. I like the company. I like that it fell so much. I like the growth. But then when I started looking at the PE and like the valuation, it's just disgusting, right? And as the company grows, which we're going to talk about in a bit, they can't keep these numbers up, right? So looking at the past 10 years, it's just not applicable because they weren't actually doing well the past 10 years. They weren't even profitable till the past 2 years. But past 5 years, revenue growth was 60%. They're not going to be able to keep that up for 10 years. The last year was a 40% growth. They're not going to be able to keep that up for 10 years. A company can grow a lot faster when they're smaller. That's why you don't see Apple, Amazon, all these companies putting that type up. Profit margin. So let's just go through and look at the low side. So let's say low side on average for the next 10 years, they can grow 15%. And then let's say even would be like 20%. And then high would be 40%. Let's just say mid. Let's play devil's advocate. Mid would be 30%. And the low would be 20. I'll say 20, 30, 40 because they are growing a lot and they do have a lot of room to grow. Profit margins 12.9, 3.8. Let's go with a conservative 4% profit margin for the low. Let's do 6% and then 8% for highs. We could put the high a little higher. Maybe we'll do like 10% and then keep 6. That's pretty good. Free cash flow. Let's do 4, 5, 6 and PE ratio 252. This is where it's really hard to do this when you're analyzing a stock like this. I'm not going to put a PE ratio of 252. It can't stay like that for the next 10 years. Let's do a low PE of 25, a medium PE of 50, and a long PE, like a high range, like very, very, very liberal with it, 75 PE, and same thing, 25, 50, 75. So if you look at the desired annual return, I'm looking at 15%. I'd hope to get more, but that's what I'm looking for. And you can see right here, based on the high assumptions. So if you're like uber bullish right now and you believe that we can hit these metrics on average for the next 10 years, you believe that we can easily get a 40% revenue growth. It's insane for the next 10 years. And you believe that profit margins can be 10%. You believe that free cash flow can be 6%. You believe, PE would be 75 in the next 10 years. Then anything under $218 is a steal. It's a steal. I don't think that's going to happen, but it would be a steal. Looking at mild assumptions, right? 30% rev growth for the next 10 years, maybe. Profit margin 6, I think that's realistic. Free cash flow 5, I think that's realistic. PE 50, that's pretty high. Anything under 43, that's what you're looking at. And currently we are under that. And looking here at the low side, which is your most conservative number, 20%, 4%, 25%, 15%, $7. $7. For me, classically, for my numbers, I would need Shopify $7. Right? $7. I don't think that's going to happen. This is not a stock that I would buy right now unless you really are confident, which I'm not saying it's not going to happen, but I'm saying unless you're really confident, at least in the mid to high, I wouldn't be touching it. If we can drop to the 20s, I would really like that. We'll see what happens. I think that this company will do well in the future. I really do. But you're not getting a deal, and I need to get a deal. That's what I need. So let me know what you think. Hit the like button, subscribe. I'll see you guys later. Peace.